Somewhere in the city you are sitting in right now, money is being laundered. Not in a back alley, not in a suitcase, in a restaurant, a car wash, a real estate office, a currency exchange counter at an airport. The Sinaloa cartel, at its peak the most profitable criminal organization in human history, was not just a drug operation, it was a financial institution. It generated $80 billion per year, and every single dollar had to be made to look like it came from somewhere legitimate. The global scale of criminal money laundering is almost impossible to process. The United Nations Office on Drugs and Crime estimates that between $800 billion and $2 trillion in criminal proceeds are laundered through the global financial system every year. That is somewhere between 2 and 5% of global GDP, moving invisibly through banks, businesses, and financial instruments that most people interact with daily. The Sinaloa cartel alone, according to U.S. Treasury and DEA estimates, generated revenues comparable to a Fortune 500 company. This is not a fringe economic activity. It is woven into the fabric of global finance. In this video, we are going to trace every step of the cartel money laundering process, from the moment cash enters the system to the moment it emerges as clean, taxable income. We will cover the three-stage model that every major laundering operation runs on, the specific techniques used at each stage, and the reason why, despite decades of international effort, the system has never been effectively stopped. To understand why money laundering is necessary, you have to understand the fundamental problem that criminal cash creates. Drug sales, and the Sinaloa cartel's primary revenue is drug trafficking, are conducted almost entirely in physical cash. Low-denomination bills, 10s, 20s, 50s. A single kilogram of cocaine, sold at the street-level retail price in the United States, generates roughly $60,000 in used $20 bills. At $80 billion per year in revenue, the Sinaloa operation generates approximately 800 million $20 bills annually. That is a volume problem. You cannot deposit 800 million individual banknotes into a bank without someone asking where they came from. Cash in criminal scale volumes is a liability, not an asset. It has to be transformed. This is why money laundering is not optional for a large criminal organization. It is operationally essential. Without a functioning laundering infrastructure, criminal proceeds cannot be spent, invested, or transferred without triggering financial intelligence alerts. A cartel boss who cannot spend his money is not rich. He is a man sitting on an enormous pile of paper that will destroy him the moment he tries to use it.
The first stage of money laundering is called placement, and it is the most dangerous phase for the criminal organization. This is the moment when physical, untraceable criminal cash must be introduced into the formal financial system for the first time. It is dangerous because it is the point of maximum exposure. Cash moving from illegal hands into bank accounts, businesses, or financial instruments creates the first paper trail, and paper trails can be followed. The most widely used placement technique historically is called smurfing, also known as structuring. The principle is simple. U.S. law requires banks to file a currency transaction report for any cash deposit above $10,000. So you deposit $9,900 repeatedly at different branches on different days, using different people. A second major placement technique is the use of cash-intensive legitimate businesses, and this is where the car washes, restaurants, and nightclubs that appear repeatedly in cartel prosecution cases come in. A business that naturally handles large amounts of cash in small transactions is uniquely positioned to absorb criminal proceeds. The business reports inflated revenues, claiming, for example, that its restaurant served 300 customers when it served 40, and deposits the legitimate-appearing surplus, which is actually drug money, mixed in with genuine takings. The business itself becomes the placement vehicle. Once cash has entered the formal financial system, once it is in a bank account or business entity, the second stage begins: layering. The purpose of layering is to put as much distance as possible between the criminal origin of the funds and their current location. This is done through a series of financial transactions that create complexity, multiple transfers between multiple accounts in multiple jurisdictions, each transaction making the trail harder to follow. The most powerful layering tool ever invented is the shell company. A shell company is a legally incorporated business entity that has no meaningful operations. It exists purely on paper, holds assets or bank accounts, and exists to move money or obscure ownership. The Panama Papers, the 2016 leak of 11.5 million documents from the Mossack Fonseca law firm, gave the world its first comprehensive view of exactly how this system operates at scale. Among the 214,000 offshore entities revealed were companies linked to verified drug trafficking organizations, heads of state, oligarchs, and financial institutions from over 200 countries. The document showed that creating a shell company in Panama or the British Virgin Islands required approximately $400 and 48 hours. The layering stage can involve dozens of individual transactions across multiple continents before funds arrive at their destination. What makes this particularly difficult for investigators is that each individual transaction in the chain may be entirely legal: a wire transfer between two legitimate appearing companies, a real estate purchase, a business investment. The illegality lies in the origin, not in any individual step, and tracing the origin requires following a chain that may span a decade of transactions across 20 different legal jurisdictions.
The third and final stage is integration, the point at which the money re-enters the legitimate economy so fully that it is indistinguishable from any other wealth. Real estate is the world's premier integration vehicle, and it is not hard to understand why. Property purchases are large, relatively unregulated compared to financial instruments, and real estate assets can be held, appreciated, and sold with a clear, legitimate paper trail. In the United States, an all-cash real estate purchase below a certain value threshold historically required no verification of the buyer's identity or fund source whatsoever. But real estate is only one integration channel. Trade-based money laundering, manipulating the price, quantity, or quality of international trade transactions, is estimated by the Financial Action Task Force to be the single largest money laundering channel globally by volume. The technique is simple in principle. A Mexican company imports $10 million worth of electronics from a U.S. company. The electronics are actually worth $2 million. The $8 million overpayment moves value across the border legally, disguised as a trade transaction. The emergence of cryptocurrency has added a powerful new layer to both the placement and layering stages, and created an ongoing arms race between criminal organizations and financial intelligence agencies. The fundamental appeal of cryptocurrency for money laundering is pseudonymity. Transactions are recorded on a public blockchain, but linked to wallet addresses rather than verified identities. In the early days of cryptocurrency, this pseudonymity was close to full anonymity. Today, blockchain analytics firms have become sophisticated enough to trace many transaction chains, but the tools to evade those analytics have evolved equally fast. The Chainalysis 2023 Crypto Crime Report estimated that approximately $24 billion in cryptocurrency was received by known illicit addresses in 2023. However, the analysts are careful to note that this almost certainly represents a significant undercount, only transactions they could attribute to known illicit actors. The true volume of cryptocurrency flows is unknown, and as privacy coin technology improves and as decentralized exchanges operate without customer identity requirements, the surveillance gap is likely to grow.
The global anti-money laundering infrastructure, the network of agencies, laws, and financial intelligence systems designed to detect and disrupt laundering, represents one of the most expensive and resource-intensive regulatory frameworks in history. The Financial Action Task Force sets global standards. FinCEN monitors U.S. financial institutions. The Egmont Group coordinates financial intelligence between 166 countries. Banks collectively spend an estimated $214 billion annually on AML compliance, and the best available evidence suggests that the global AML system successfully disrupts somewhere between 1 and 2% of total criminal money flows. The other 98 to 99% moves through undetected. There are structural reasons this failure rate persists, and they go deeper than enforcement resources or cross-border coordination difficulties. The fundamental problem is that the global financial system and the global laundering system are not separate and opposed, they are deeply intertwined. Major international banks have repeatedly been fined billions of dollars for knowingly facilitating money laundering. HSBC paid $1.9 billion in 2012. Deutsche Bank paid $630 million in 2017. Standard Chartered paid $1.1 billion in 2019. These are not rogue actors, they are some of the largest financial institutions in the world. The Sinaloa cartel's laundering operation was not a single system. It was a diversified portfolio of laundering channels operating simultaneously. U.S. Treasury Department and DEA documents describe an operation that used bulk cash smuggling across the U.S.-Mexico border, disguised as legitimate cargo and produce shipments.
a network of hundreds of exchange houses, casas de cambio, along the border that converted dollars to pesos outside normal banking channels. Real estate investments across Mexico, the US, and Central America through networks of shell companies. And a sophisticated trade-based laundering operation through import-export businesses that created legitimate-appearing invoice trails for value transfers. The most consequential money laundering case involving the Sinaloa cartel came not from drug enforcement, but from banking. In 2012, HSBC, one of the world's largest banks, agreed to pay $1.9 billion in fines after U.S. investigators proved that the bank had processed hundreds of millions of dollars in drug cartel proceeds, including Sinaloa money. Internal HSBC documents revealed that compliance officers had repeatedly flagged the accounts and been overruled by senior management.
Here is the uncomfortable conclusion that every serious study of global money laundering arrives at. The system persists not because enforcement is weak, though it often is, and not because the criminals are too clever to catch, though some are. It persists because the global financial infrastructure that criminal organizations exploit is the same infrastructure that legitimate global commerce depends on. You cannot shut down the mechanisms of international finance without shutting down international trade. The drug trade generates its revenue in cash on street corners. It moves that cash through the same financial infrastructure that moves legitimate wealth. And it emerges at the other end, owning real estate, legitimate businesses, and investment portfolios in cities all over the world. The money sitting in a Miami penthouse apartment may have begun as a $10 bill in a street transaction. The system made them indistinguishable. If you want to understand the full picture of how criminal organizations build and sustain their financial empires, our video on Pablo Escobar's cartel empire takes the business model from the other end, how the money was generated before it ever needed to be laundered. The link is on screen. And we want your question. Which criminal financial system do you most want us to break down next? The cartels, the Russian oligarchs, or North Korea's cybercrime operation? Tell us below.